Hi, everybody. Welcome to our Tobias Financial Advisors market update, where we'll be previewing the 2023 outlook, as well as reviewing what happened in the fourth quarter, as well as 2022 in the financial markets. Happy to have everyone attending today. A couple of ground rules before we dive into our presentation. This is a general information session. We'll be talking about different themes that we're seeing throughout the economy and in the markets, but this is not meant to be personal financial advice to you. We do recommend, if you have any questions about what you see today, reach out to your planner or wealth manager here at Tobias Financial Advisors, as again, this is going to be kind of a general session to talk about the markets. Also, under the handouts section of our webinar platform here, you can download the slides. We have a lot of information on these slides today, so you might want to take a deeper look. Please download through the handouts section. And finally, we have a chat feature. If you'd like to put any questions into the chat, we'll try to tackle those if we have time at the end of the presentation to answer those as best we can. Who we are, Tobias Financial Advisors. We have been around Plantation, Florida since 1980, helping many individuals with their financial planning needs. We work with families as well as small business owners, some 401k plans, retirement plans. So we're really here to help guide you throughout your financial life and really help you live the life that you want. And that's really what financial planning and investing is all about. For most people, that is the goal, to help them achieve the life that they want to live. We highlight our education. We have certified financial planners on the team, certified public accountants, chartered financial analysts, and various different designations amongst us. So we value education very highly. Today, my name is Matt Sainholtz. I've been with Tobias Financial Advisors since 2005. Senior Financial Advisors and Chief Investment Officer. Happy to be here. Happy New Year to everybody. I'd like to introduce Melanie Leo Ramirez.
Thank you for having me. My name is Melanie Leo Ramirez, and I am a client service specialist with Tobias Financial Advisors. For those of you that may not be aware, I joined the team in March of last year, and I'm happy to be here. Thank you.
Thanks, Melanie. And Chad Neesmith, our portfolio analyst.
Hi, hey Matt, thanks for having me on. Happy to be here. This is going to be a great webinar. I've been with Tobias a couple of years. I'm the portfolio analyst. I do trading and research for the firm and interact with clients and sometimes in meetings. So I appreciate the time.
Excellent, thank you. And just before we dive in, a little bit high level on how we invest money. We work with our clients to develop an investment plan that's specific to you, your family, and your goals. And once we kind of figure out what we're investing for, then we structure the portfolio around different dimensions of risk and return. We think about different types of asset classes, whether that's fixed income or bonds to stocks. And we want to diversify broadly while always keeping in mind how we can save money for you by reducing some expenses in the investment portfolio and minimizing taxes. Those are some high-level targets that we try to achieve for all of our clients. And we do have some folks on the webinar today that may be watching that are not clients. We encourage you to give us a ring, and we will do a complimentary portfolio review to see how you're positioned. And coming off the year of 2022, it's probably a good idea to have a professional take a look at how you're positioned and how you are achieving your returns and what your goals are for investing. So we invite you to do that as well. Today's agenda, we're going to take a look at a 2022 market review. Then we'll be looking at some themes we're seeing for 2023, some important data points. Melanie will be highlighting some features on our new portal, our new website portal that allows you to see your investments, and she'll be highlighting those as well. So let's jump right into it. Before we get into what actually happened, let's rewind about a year ago. And we had, just like we see today, we have people in the financial media, different investment banks, you have the whole wide range of estimates out there. What the market's going to do? We get that question as well. What's the market going to do this year? And all these professionals last year, for the most part, most of them we had started last year at about 4,700, 4,800 in the S&P 500, had predicted a positive year of about plus 10%. The most negative person was about Morgan Stanley. That MS stands for Morgan Stanley. They were forecasting a negative 10% year. And unfortunately, for all of us, it was actually worse than what everyone expected. It was actually down over 12% from the worst prediction. And I just wanted to highlight this because it's like trying to predict the future. We know no one can actually do that. And when we're investing, we're thinking about it as a long-term commitment. We are investing for the long run. And so, there are going to be ups and downs in the markets. And we saw that in this past year. So I wanted to highlight and remind folks, as they see these types of new year type of predictions in the financial media, to take them with a grain of salt and really worry about your particular situation. But wanted to just rip the Band-Aid off here, and you can see the headline on this slide dating back to 1926. The fixed income or the bond side of the portfolio, the returns for the benchmark, not necessarily what our investors experience, but the benchmark, the measure of what the U.S. bond market did, was actually down 13% in 2022, making it by far the worst year on record in the fixed income space. The average year is down about 2.5%, and we registered a negative 13% in 2022. Why? Mostly because interest rates, due to the inflationary environment we're in, interest rates went up substantially. The Fed kept raising rates, and when interest rates increase, the value of existing bonds typically decrease. And that's why we see this big downturn in the bond market. In our chart, typically when this happens, on average, the forward-looking returns over the next 12 months are positive. So we are kind of expecting that again, but we will let Chad will have some more information about that in a bit. Combine that with the other, for most folks, the other part of the portfolio, U.S. stocks, which is another asset class that we use in our portfolios. It was the seventh worst year ever, since 1926, and that registered at a negative 18%. And again, that's kind of a coming off. Valuations were high. We had some different things that happened in the world, and also just the threat of inflation and the R word, which is recession. We'll be talking about that as well, but the potential for a recession. We're not official yet, but we did see some slower growth in the economy. So it was a very, very tough year in a balanced portfolio and a diversified approach, but just about everywhere was down. So thinking about the fourth quarter, what we just witnessed here is actually, you can see a lot of green arrows on the screen here. We've had some things that happened in the fourth quarter that were positive. Around October 12th, the S&P 500 bottomed out. And as we highlighted actually in our last webinar, we had said, well, when the midterm elections clear themselves and we get past those, we may have some positive returns because the market doesn't like uncertainty. And that kind of did come to fruition this year, where the midterms came and gone. Democrats kept the Senate, Republicans took the House, and we had a divided government, but that uncertainty was behind us. And that, combined with the Federal Reserve thinking about potentially slowing the pace of interest rate increases, had some positive returns in the bond market. And we also saw international stocks do a lot better compared to the U.S. stock market, almost doubling the returns in the fourth quarter for international stocks as well. So positive returns across the board. Unfortunately, we were coming off, at the lowest point, the S&P 500 around beginning of October was down about negative 24% for the that point year to date. We did come off the bottom there a little bit. So year to date asset classes, there's a lot here. I'm not going to highlight every single asset class, but these are just different types of countries or fixed income or different stock markets you can invest in globally. And Chad and I refer to 2022 as the year.
Nowhere to hide, yeah.
Nowhere to hide, really, this year. There's only a couple asset classes that were positive, Brazil and crude oil. But if you look across the globe, again, there's just nowhere to hide. And the U.S. bonds, which are typically down only a couple percent in the worst years, were down 13, 14%. The S&P 500 ended the year down negative 18%. China was down negative 22%. And then, what's been kind of the darling and has been working for the past 5 years, the NASDAQ or growth companies here in the United States have had the worst year across compared to these different asset classes of over negative 33%. And those are some of the names that we all love in the tech world, like Apple, Amazon, some of these names that have just had a tremendous run and are very high quality companies, but they are coming in with high valuations. And that story of paying a lot meaning their price to earnings ratio were high, and you're still buying into it for future growth. That's kind of coming full circle in the past 12 months because of the higher interest rates, and now you can actually be in a bond and have some returns. One thing that's not even on here that kind of highlight too is if Bitcoin was mapped on here, it would be way over here at negative 65% for the year. The cryptocurrencies have it just as bad as the year and worse than anybody else. And we're still kind of we are still in the camp of that there's not a lot of underlying value in the actual cryptocurrency. Maybe in the technology, maybe in the blockchain, but the actual cryptocurrencies, there's not a lot of, doesn't pay you a dividend. There are things that we are cautious about, and we've been cautious about for many years in the crypto space, even though we've had clients ask us and other folks try to maybe have us invest in cryptocurrency. We've still stayed on the sidelines, and it was a good thing we did because it was a negative 65% return last year in Bitcoin alone.
Yeah, it's crazy how volatile that asset class is.
Absolutely. So to kind of wrap up the 2022 market performance here, you can see on the 1 year returns, you have red across the board on just every asset class that is highlighted here. But as a reminder, we're long-term investors. Over the 5 and 10 year period, it does still show positive returns. And it just goes in to show one of my favorite adages and phrases. It's about time in the market. It's about the time you invest your money, letting it grow, having a long-term horizon rather than timing the market. So time in the market is more important than timing the market. And with that, I want to kind of pass this over to Chad to give us a little bit more about the topics and focus for 2023.
Yeah, we're starting out strong here with inflation. You may have heard a little bit about this in the news over the last long time, 12 to 18 months. I know inflation is a big concern for a lot of people, especially when you go to the grocery store. You're definitely seeing these higher prices in food, I'm seeing it in rent, everywhere. It seems like prices are going up. But the good news is we're seeing that inflation has likely peaked, and that's the growth rate in prices. So total prices are still going to go up, but it's happening at a slower pace. So where we topped out last year in June at 9.1% year-over-year inflation, the last reading in December is 6.5%, and that's the first time we've been under 7% in a very long time. These numbers are on the left side of your screen, as you can see. And a big part of that was the help in energy prices. We had really high prices at the pump over the summer, and those prices have come down a lot recently, which has really helped purchasing power for a lot of consumers. There is a little bit of concern because we are still seeing shelter in the dark blue at the bottom of this graph. You can see shelter inflation is still picking up, and that's what's known as sticky inflation. So that's tied to long-term wages, and that's going to be a little bit tougher to combat. The Federal Reserve, as they increase interest rates, they're trying to combat inflation, and it's going to be difficult for them to rein in this shelter increase over time, but eventually it will roll over. Eventually it will. It's just a matter of time. And shelter is 1/3 of total inflation. So that's where 1/3 of our price increases are coming from, is the shelter inflation. So it's something I'm watching very closely, along with wage growth, which isn't on this screen, but just so you know, wage growth is tied to the sticky prices and it peaked at 6.7%, and now it's come down a little bit to 6.1%. So we are seeing a nice trend in both prices and wage growth over time. So it's really promising for the Federal Reserve. That's a big reason you may be seeing in the headlines that they're slowing the pace of interest rate increases. We are expecting to have them increase by 0.25% next month. However, it's a lot better than the 0.75% we've seen for the last 4 meetings, or how, over the last year. It was a really, really fast pace in interest rate movements. So that's good news. And the other good news is on the right side of your screen, you can see inflation expectations. And this is what the market thinks that inflation will be over the next 5 years. We see several different ways that this is gauged. First being consumer expectations. And they also take professional forecasters. So they take surveys from professionals where they think inflation will be. And then lastly, in the gray line, they'll look at break-even rates between bonds. And that's something you can look at in the fixed income markets. When you look at nominal bonds versus inflation-linked bonds. I won't get too technical in that, but that's a reading you can use for the market expectations for inflation over the next 5 years. And you can see these are between 2 and 3%, which is historically where we've been with inflation. So even though it's a 6.5 right now, expectations are over time we're going to get closer to the 2 to 3% range. It's just a matter of time. Is where we're not sure when it's going to happen. So that's good news. That's good news. That's something that you may not be seeing in the headlines because it's hard to it's easy to see only the bad news that inflation's high, but it is coming down. So that's great. We're gonna move on to bonds. So part of the reason that inflation has come down is because the Federal Reserve has increased interest rates, and it's really brought down a lot of asset prices. But the good thing is we're getting paid to hold cash, and we're getting paid to hold short-term investments for the first time in 10 years. And right now, money markets are paying 4.25%, and that's just short-term cash investments. And when the Federal Reserve increases interest rates a 1/4 point, maybe 4.5%, if they raise a little bit more, we might get up to 5 by the end of the year for just short-term investments. And so that's really good news for someone who has cash on the sidelines and wants to invest it. This also really rolls into bond prices and what we're getting in yields in 2 and 10-year or 2 and 5-year treasuries. You can see on the left side of your screen here, 2-year treasuries right now are paying you 4.25%, just like the short-term money is that we just spoke about. In 5 years, 3.6%. That's the highest it's been in a while. And then if you go further down to IG Corps, that's investment grade corporates. So that's high quality bonds like Coca-Cola, Procter & Gamble, Google, Microsoft, the big companies that have really good credit ratings. You're getting paid 5% to hold their bonds right now, which is something that we haven't seen in a very long time. And that's really good news for investors forward looking. And we'll talk about the diversification benefits that that's going to have in future slides. But on the right side of your screen, bond yields and bond prices have an inverse relationship. So whenever yields go up, prices come down. As we saw last year, yields went really, really fast. Rates went up really fast at a really sharp pace, and prices went down really fast. But now that we are being paid some to hold these bonds, there's a cushion that we get. So if interest rates were to go up another 1%, and we're holding a 2-year treasury instead of the price going down, it would still increase by about 2.5% over the next 12 months, which is really good for someone who's looking to invest. You get an added benefit of being able to get that yield going forward. So that's great. Get this coupon cushion. So that's really promising for bond yields. And we'll go into the next couple slides. We'll go into some investment themes for you. So this is investment themes 2023. Got a few more things to cover for you. The first one on the next slide is going to be consumer expectations. So you as a consumer may be having a very poor outlook on the economy over the next 12 months, as are a lot of consumers. On this screen, this is a consumer confidence index. This is a University of Michigan gets this every month or so for consumers to gauge their expectations on the economy. Right now, December, the reading is 59.7, which is, as you can see, historically pretty low. This goes back to 1971. This graph does. And you can see on this slide, on the blue points, it's got the forward 12-month return of the S&P 500. And if you were to go back and average all these dots, the peaks are going to be, whenever the consumer is the most confident about the economy, the S&P over the next 12 months returns 4%, which is still positive. However, if you were to buy when people just really don't like things, you would get almost a 25% return, 24.9% return, which is, it's promising data to look at when you're thinking about pessimism and possibly buying at the valleys of when a lot of consumers are not super excited about the economy. But we're not necessarily market timers, but this is just good data to review and to think about. We'll go to the next slide. We'll talk a little bit about just how the market leads the economy. And this is a graph that shows the S&P 500 return in dark blue and then industrial production in that teal color. And as you can see, the S&P 500, the market is smart. The investors are smart. They kind of can see when, the recession may be coming, even though the data is not showing it yet. And that's something we've seen, even this last pullback, the market came down before we saw any really bad data coming through. And so the market's down, and it was down 18% last year, like we spoke about. And we're starting to see industrial production come down. It peaked in September of last year, and it's been coming down ever since. Now, we don't know where the bottom's going to be. However, it's really hard to time these things, where we could have a recession and the market could rally through the recession, given that the market could have a worse recession priced in. And if it's not as bad as what they think, then the market could rally on that. Not as bad as expected news. So timing investing is just extremely difficult, and you really have to have just a plan that you stick to it. And Matt mentioned earlier about having time in the market versus timing the market, which I think is just a really good quote and a really good way to think about investing.
Yeah. I mean, effectively, you can't wait till the water's hot. I have come up with some of my clients and some investors I speak to and say, well, I don't want to invest now because we're in a bad spot economically, or the forecast doesn't look great. And just as you mentioned, Chad, typically the market starts to recover prior to the bottom of when the data actually arrives to show that we were in a recession or that we had negative growth. So, again, you can't time it all exactly right, but you can't necessarily be scared when everyone else is scared. You want to take advantage, especially this year in 2023. We have increased amounts to contribute to your 401k. You can increase your amount to your IRA. So there's some different things that passed recently, so you can increase those amounts to invest.
Yeah, I mean, that's great. And, you got to think about if the market's going down and you're having a nice balanced portfolio, then you're going to be buying stocks on the way down as you rebalance. So, you are going to be purchasing effectively as things go down and slowly kind of selling things as you rebalance as they go up. But other themes in the year, we're talking about international investing. This is something that has been, a lot of people have not been excited about international investing for a very long time. This graph shows, in the purple, whenever international stocks lead US stocks, and in the gray, whenever US stocks lead international stocks. As you can see, since 2008, it's been all US, and international stocks have lagged. And this has been the longest that we've seen, dating back to 1971. And so what it's done is it's created a discount for a lot of international stocks, where on an earnings basis, you're getting to buy these stocks for about 30% less on an earnings basis than you would be able to buy US stocks. And so we're starting to see that play out a little bit of this trade unwind in the last 3 to 4 months. As you can see in the right side of the screen, you can see the peak is coming down a little bit, but it's not going to completely change until we get 12 months of a regime change in this graph. We're probably coming up to 12 months pretty soon in this graph. So yeah, last year, in the last 3 months, international stocks have been up 22%, and domestic stocks have been up 5.5%. That happened really quickly, and you wouldn't be able to catch this if you weren't invested in international stocks. So it's something that you definitely, you need it in your portfolio, because these things are, they're not correlated in 1-to-1, and you get the benefits of diversification, and you get to buy them at a discount right now. And they're going to have some good headwinds, some tailwinds coming up, as we will see in the next slide. A really big tailwind for international stocks is the dollar index. Right now it's trading 102. As you can see, this chart goes back to 1998. The dollar was at its highest in the early 2000s, right at the dot-com bubble. But really looking back the last couple of years, the dollar has rallied a lot. And that's had to do with it's related to interest rates and the Federal Reserve increasing rates so quickly. A lot of people have fled to the dollar as a safe haven, just given the uncertainty of interest rates and the movement of those rates. However, whenever the dollar goes up, it is really good for someone wanting to travel. So if you wanted to go to Europe or travel anywhere for vacation, your dollar's worth more as a tourist. However, for an international investor, whenever they translate those earnings back to US dollars, they're worth less. So it actually creates a big headwind for international stocks. However, we've seen, the dollar unwind a little bit. And at one point, it was up 18% last year from the start of the year, which is a gigantic move for a currency. Usually currencies do not move that much. But we're seeing that unwind a lot this year, and it's really helped international performed really good for the last few months. We haven't seen it in a very long time. So that's a promising thing that we're looking for this year, is for international to continue to do well and to benefit our portfolios. And we really like buying them down, owning them at a discount compared to US stocks. So I think that we're going to go to the next slide. It's on diversification. This all wraps into diversification here. So this is a chart that shows the S&P 500 versus a diversified portfolio, and that portfolio is made up of US large cap stocks, which is the S&P 500, mid cap stocks, international, small cap, emerging market stocks, and 40% bonds, 25% US bonds, and 15% high yield bonds. And it shows different time periods where if you held the S&P 500, this is the performance you would get versus a diversified portfolio, the performance you would get. And you add up all these periods going back to year 2000, you still wound up ahead owning a diversified portfolio, even though it didn't quite feel good for a lot of those time periods. So it may feel like being diversified doesn't necessarily feel good. So for example, in 2008, if you held a diversified portfolio, you were down 26%. You lost money, right? But for someone holding the market, they were down 37%. So they just didn't, you didn't lose as much. And that's a really big win for an investor, is to not lose as much as the market does, and to really win on those losing years, even though you lost money. And then it's really hard whenever all your friends are making money hand over fist and the market's up 351% from 2009 to 2019. You're thinking, oh man, I didn't make as much money as my neighbor across the street. Talked to him, but at the end of the day, you end up with a smoother ride, and a lot of really great benefits from diversification. Now, last year in 2022, we saw a breakdown in diversification, and something we haven't seen, for a very long time, where fixed income was yielding so little, and bonds performed so poorly that everything was down. Like Matt spoke about earlier, that so many asset classes were down really heavily. But going forward, this isn't going to be the case, because now we have, or it's unlikely, very unlikely it's going to be the case, because we are being paid to hold bonds, and we're being paid these coupons, and we have this cushion, we have this safety net of yield in fixed income for the first time in a long time. And we also have these benefits of international that we're seeing, and other parts of the portfolio that work other than just large cap growth, domestic companies that have worked for a long time. So overall, this is just really good to have a diversified portfolio with a lot of different things working for you. And it really helps smooth out your plan, and it helps your financial planner gauge, what your life's going to look like down the road. So it's really good. Go to the next. I think we're going to pass it on to Melanie now to talk about the investment portal. Yep.
So we are excited to share that our team has been working hard to provide you with a new updated client portal that you can access anytime. There's no action that needs to be taken by you for the update. Your login credentials, as well as the link you use to access your portal, will remain the same. And once you're logged in, you can see how your investments are performing. You can review recent activity and transactions, as well as access quarterly statements. We also want to let you know that coming soon, later this year, the updated Tobias mobile app will be available for download. On the next slide, the personal finances page overview. Here you can review the account summary for the entire household. It's a new updated look and feel. And you can also update the time frame by clicking on the top right page to review various data, including returns, market value, and allocations. The performance page overview. When you click on the performance tab to view graphs and more detailed information, you get a nice updated look as well to the graphs. But if you want to drill deeper into a specific account, you can use the transactions page. The transactions page shows the date the transactions occurred. It shows the description, units, price, and the total amount. In addition, there will be a document vault. Now, this document vault is where Tobias Financial Advisors will share important documents such as statements, and you will have access to your custodial statements as well. We also want to let you know, coming soon, later this year, keep a lookout for our updates. We will notify you with more details. The updated Tobias mobile app will be available for download on the App Store and Google Play. You can enjoy all the new features of the client portal from your mobile device.
Great, thank you, Melanie. I really appreciate it. Now we're gonna wrap up a couple of closing slides. Just 23 through 23 outlook insights. We got some points of optimism, some good news, thinking about the economy and the markets as the labor market continues to be strong. The economy is adding jobs every month. You know, we've seen some layoffs in tech, but we haven't seen that broad base across a lot of sectors in the economy yet. So, I mean, that's really good. As we spoke earlier, inflation has likely peaked and it's coming down. That's the growth rate in prices. So that's really good news for us. And then bonds, as we said, are yielding more than they have in a very long time, 10 years plus, ever since a great financial crisis. That's really good for anybody looking to pick up some yield and for some cash sitting around. And then lastly, China is reducing their zero COVID policy. They're actually opening up the economy again. That's really good for import prices. That's really good for global GDP. That's good for China's economy, but it's also good for us as someone who has trade with them and a lot of trade with China. So that's really great.
Another point on the side of international investing that one of our themes here for 2023 is just what Chad said, that China being a major global economy, reopening its doors, kind of letting lapse their COVID policy a little bit and seeing that manufacturing take off, which should be an additive to the global economy and ultimately the portfolio if you're invested globally.
Mm-hmm. Yep. That was great news. We do have some points of caution. These aren't necessarily bad things, but this is just things that we have our eyes on. The Federal Reserve is still tough on interest rates. You know, they did increase the rates a lot. They're slowing down, which is good news, but they're still increasing rates, you know, on an absolute basis. So that's something that we're keeping a close eye on. Inflation, even though it's coming down, it's really hard to predict. You know, we have a nice trend right now, but it could get stuck at 4%. We're at 4 or 5% if we can't get the shelter and sticky inflation to come down like we spoke about earlier. But if things also go, you know, really bad, we could see deflation, which is prices coming down. But yeah, and then lastly, Congress is going to have to deliberate the debt ceiling. You may see that in the headlines today. They're going to have to talk about raising the debt ceiling. We don't really see, you know, a really big deal with this. It just could cause some upset stomachs in the market. But we do think they're going to raise the debt ceiling at the end of the day. So
yeah, a lot of posturing is already happening. You'll probably, from what the analysts say, it might even last all the way out to the summer. Hopefully we'll get a deal before that and put this behind us, and the government can pay its bills and keep our high-rated U.S. bonds. But you know, it's going to have some political theater before we get there.
Yeah,
that's for sure.
Absolutely. Political posturing. Yeah, it's coming. Just talk about the portfolio before we close it out. Just 3 different sectors of our portfolios that we're looking at for anybody who's interested: fixed income stocks and opportunistic areas. In fixed income, we're lowering duration because we're getting paid on the short end. You know, like we talked about earlier, money market's paying us 4.25, and that doesn't come with any interest rate risk. So it's a pretty good absolute return, you know, going forward. So we're lowering duration a little bit, meaning we're buying bonds that are mature sooner. So instead of owning, let's say, like a 10-year bond, we may own a 5-year bond, and that's not exactly what it is, but that just gives you an example of what lowering duration means. We're also keeping our bonds high quality. We're staying away from really junky stuff, as a recession may be a possibility if we were to buy, you know, lower quality credit. We're trying to stay away from that right now. On the stock side, we're looking for rebalancing opportunities. We're maintaining our international exposure. Now we're trimming it a little bit because it's done well. We're maintaining it on the model, but we're seeing rebalancing opportunities where, you know, recently international's done really well. So we may be selling some international to buy bonds just to keep the percentages the same, just normal rebalancing. We're not changing anything. We're just letting, you know, international do its job right now, and it's doing really well for us. And we're keeping, we're keeping that exposure, and we're also maintaining that quality companies are still attractive. We don't want to get super risky companies on our stock side either, but we do like quality companies. We think they're going to do well in this environment. Now, on the opportunistic or tactical side of the portfolio, we're pretty defensive in this area right now. We haven't really seen a ton of really great opportunities, so we're staying defensive for the time being. We have a nice market neutral position. We've recently removed commodities exposure from portfolios. We've seen commodity prices come down. As you may notice, the energy prices have come down since the summer. So we did remove that from portfolios because we think that that's, it worked its way through last year, and we just think it's better to remove that from the portfolio right now. But we are exploring an aggressive move into risk assets if we see an opportunity present itself. We are constantly reviewing investments and opportunities in the market, and we'll have some news for you whenever that time comes.
Yeah, I mean, ultimately, we all know the markets don't move in a straight line. On average, average downturn in a normal year for stock markets dating back 30, 40 years, there's usually a 10% drawdown at some point during the year. And, it's no reason to think that's not going to happen again. So we're optimistic. We have, as Chad said, we have good forward-looking returns ahead of us, better than they were last year because of the repricing of bonds and the repricing of stocks. So to be an investor, you're forward-looking, your 12 months, your 5-year, your 10-year type of returns forward-looking have improved since we've lived through this downturn in 2022. So we're excited, we're optimistic, and we'll be doing these webinars on a quarterly basis as usual. But please reach out to us with any questions or concerns, any feedback on our new portal or updated portal. We'd love to hear it, good or bad. We would like to hear any sort of feedback on the portal. We'll let Melanie take those for sure. Absolutely. Reach out to us when you can. Thanks for joining us, Chad, Melanie. It's been a pleasure. And for everyone out there, have a happy new year, and please keep in touch. Thank you.
Thank you.
Thank you so much.